se destaca por su trabajo sobre financialización y crisis en los componentes reales financieros de nuestro proceso de acumulación. Y pues bienvenidos, y todos aprovecharemos su conocimiento. ¿Quieres tú decir algo?
Quisiera dar algunas indicaciones. La conferencia se va a hacer en inglés. En caso que no entiendan ciertas cosas, no duden en levantar la mano, podemos ir traduciendo, especialmente los términos que no se entiendan. Vamos a hacer un pequeño receso en la mitad de la conferencia. El profesor Orhangazi sí entiende español, entonces al final se puede generar una discusión. Ustedes pueden preguntar en español, yo no entiendo que se pueda traducir, pero el chiste es que podamos aprender de lo que está sucediendo hoy día en el mundo. De hecho, pareciera que la situación de Turquía, que es de donde viene el profesor, no es tan diferente lamentablemente a la nuestra. Entonces puede haber ahí una complementariedad en lo que podemos discutir. I would like to thank Özgür for coming. It's a long way, and I hope we can enjoy, I'm sure actually that we will enjoy your presentation, hoping to start a new relation in terms of work. Quisiera agradecerle al Posgrado, doctor Huerta, en haber dado todo el apoyo para realizar estas conferencias, y pregunten, abran los ojos, los oídos, y a ver qué podemos sacar de esta historia. Gracias a todos, gracias a los chicos del proyecto, estamos muy participativos, y a todo el mundo que ha venido.
Buenas tardes. Gracias a Dr. Huerta y gracias a Dr. Levy para invitarme, y gracias a ustedes para estar aquí, para escucharme. Pero mi español no es tan bueno, y por eso tengo que presentar en inglés. Eso es todo que español. Just go there.
Okay, anyway, I will be here for the... Okay, I'll
That's
go.
easier for me too.
Okay.
Well, thank you very much. My talk today is going to be on the theory of financialization and how it relates to the crisis in the US economy, in the United States economy. And what I will try to do is I'll try to go slow, but anytime if you have any questions, if there's anything you want to clarify, you can just raise your hand and you can interrupt me, and I'll be happy to do that. Or if you have sort of bigger questions, we can talk about them at the end of the presentation as well. So what I want to do, basically, is, so this is the outline of the talk. This is the outline of what I want to talk about. First of all, I want to talk about different approaches in the economic theory to the issue of finance and financialization. And after that, I want to talk about how the US economy was affected by this process of financialization. Okay? And then in the third section, I want to talk about how financialization is related to the process of accumulation in the US economy, and how financialization is related to four main problems of the US economy, as I see them, as I identify them. In the US economy, since 1980s, more or less, there has been, to different extents, four different problems on the demand side, on the production side, as well as on the financial market side. And then I'll talk about how this relates to what people call global imbalances, the huge trade deficit of the US economy. Okay? So what we have, let's start with the theory. I'm sure like some people here are already familiar with these theories. but sort of I'm going to present my take of this. Basically, this is a very general overview. But basically, when you look at theories of finance, what you see is three different approaches. Okay, one, what we can call the mainstream approach, or the neoclassical approach, which basically talks about how financial markets improve the efficiency of the economy. In this theory, usually financial markets have a positive role on the economy, and the monetary issues don't really affect the economy. They're sort of like a veil, so to speak. And then there's a second approach that you can lump. There are different sort of like sub-approaches under all these ones, but the second approach that I identify is the Keynesian approach. In the Keynesian approach, there's a famous sort of like call for the euthanasia of the rentier, which basically means finance is seen as something that could potentially create problems in the economy. For that reason, finance should be regulated, should be controlled, and should be made to serve the economy. Okay? And then there's a more sort of like marginal, so to speak, approach coming from basically Marxian economists who argue that finance has what we can call a dual role. A dual role in the sense that finance both helps accumulation, but at the same time creates conditions for crises. Okay, so in that sense, it has a contradictory role. So let me just speak a little bit about the variations of these approaches. So in the standard approach, for example, if you take any finance textbook or if you take any economics textbook, this is the approach that you're going to see. And when we talk about finance, think about the economy as divided into two sectors. Okay, one sector basically does the production and distribution of goods and services. Okay, and the other sector, which includes banks and financial institutions, okay, investment funds, hedge funds, and other types of financial institutions, carry out the financial activities. Okay, now in this approach, basically the role of the finance is to allocate funds, to allocate money to different users for production and distribution of goods. And finance does this by allocating resources to their most profitable users. So for example, what it does is it, in a way, gathers all the resources from the economy, gathers all the funds together, and then looks around the most profitable businesses. The most profitable businesses are also assumed to be the businesses that would produce most useful things, so to speak, where there's demand, okay? And then allocate funds according to this. Now, in general, the problem is, as seen in the mainstream theory, the problem is there's a limited amount of funds in the economy. Okay? So if you have a limited amount of funds, the banks will look at the economy and allocate funds starting from the most profitable and then go down. So if you have less profitable businesses, if you have businesses that don't look like they're going to be useful, okay, then they'll get less funds, and the other ones will get more funds. Now, one of the things in the theory is if the size of the financial sector grows, if you have a larger financial sector, and if you have more financial activity in an economy, this is going to improve this role of the finance. Okay? And most of the time, you're going to see talk about what, as a concept, financial deepening. Financial deepening refers to the process of finance getting larger and more complicated. Okay? For example, if you have different financial institutions, not only banks, but investment funds, hedge funds, different sorts of funds, and if you have different ways of doing financial business, for example, if you not only bank loans and stuff, but also, for example, derivatives, different types of loans, different ways of securitization, this is considered to be an improvement for the economy. Why? Because if you have this, then the financial markets or the financial sector will be able to allocate resources better. Or in other words, the financial sector will be able to allocate resources into more efficient uses. Okay?
¿Pueden sentarse para que no se esté molestando? Y hay lugares ahí. Siéntense porque no hay nada aquí, por aquel lado, porque me da cosa. Sorry, miren, ahí hay un lugar. Y aquí hay sillas también. Sorry,
So in this sense, there's one little problem. Think about the economy. On the one side, there are funds, there's money. On the other side, there are businesses. So the businesses need the money to make the investments. The main problem in this setup is that when the banks or financial institutions lend money for these uses, they always take a risk. The risk is the money may not come back. The business may go bankrupt. They might lose the funds. They may not be able to make profits. Or if they lend money to consumers, consumers may not be able to pay back. Okay? So there's always a risk. Now, the main problem from this side, from the production side, is the need for funds. From the side of finance, the main problem is how to allocate these resources with minimum risk, because you don't want to lose these resources, okay? Now, the idea in mainstream theory is if you have different types of financial institutions, and if you have different types of financial assets, then the risk is going to be managed better, or the risk is going to be minimized as well. And only those who want the risk will take the risk. Only those who can carry the risk will take the risk. And in a sense, finance will provide what we can call hedging. That is sort of like hedging against the risks. Okay? Now the second thing that in this system that finance will do, well, the third thing, the first is allocate the funds, allocate the risk, and then the third thing is the economy is very complicated. There are tons of different firms, there are tons of different opportunities to invest, there are tons of different things you can do with funds. And it's impossible for people to understand which ones are risky, to understand which ones are profitable. You have to study the books of the companies, you have to study everything in the economy, try to figure out, and it's a very daunting task. It's a very difficult thing to do for people. So what finance does is also, finance provides information about the economy. Okay? Think about it like this. Think about, for example, the stock market. In the stock market, you have stocks, shares of different companies. And they all have different prices, okay? So these prices are supposed to reflect how profitable these companies are. So if you have a profitable company, your stock price is going to be higher. If the company is not doing good, the stock price is going to be lower, okay? So in that way, for example, if you want to get any idea about the economy, you can look at the prices of the stocks. Same thing. For example, if you're looking at government bonds, okay? If for a government, the price of the bond or the interest that the government pays on the bond is high, that probably means that there is some problem with that government, okay? For example, if you look at bond prices of the US government and the Mexican government, you'll see that Mexican government pays a larger interest rate, okay? This, in the mainstream theory, is a piece of information. It tells you that the Mexican government is riskier than the US government, for example, okay? So, in that sense, that finance is supposed to give you information, okay? And does this information by two mainly the prices of the financial assets. Okay, the financial assets will tell you this price. So if you put all these together, if you put all of them together, essentially what you want in this theory is a financial sector that is not constrained. In other words, you want a liberal financial sector. You want liberal banks. You want financial institutions that are minimally regulated. You know, that way they can do their function of improving the efficiency of the economy. They can do their function of allocating funds, and they can provide better information about the economy. Okay? So in a way, if you have a growing financial sector, if you have a lot of financial activity, that's good from the mainstream economic perspective, from the mainstream financial perspective. Okay, so that's sort of like where you are. Now, we'll see how this relates to the other ones. In the Keynesian approach, what you see is different. In the Keynesian approach too, you need finance. Okay? You need finance, but finance does not necessarily do allocation in a good way. Okay? Finance is not necessarily going to improve efficiency. What you need to do is you need to put rules, certain rules, about what banks can do and cannot do, what financial institutions can do and cannot do, in order to make sure that you get the most out of the financial sector. So if you compare it with the different perspective, in the first one it says, let them do whatever they want, and it's going to produce the best outcome. And this one says, no, make sure what you want in the economy and design the financial sector accordingly. Because the idea is, if you leave banks alone, okay, they will try to maximize their profit. They will take risks, and they will basically create a situation where you can see a lot of fragilities in the economy building up. Okay? For example, what you have in the US after 1980 is a process of financial deregulation, in the sense that after 1980s in the US, a lot of the rules about the financial sector were either removed or relaxed, okay, to let them function according to the first theory. All right? And the Keynesian theory, as we will see, sees these policies as a problem, okay? Because what happens is essentially financial sector, the profits of the financial sector are taken out of the production sector, out of the real economy, okay? So in that sense, finance impinges upon the real economy. Finance is something that takes away resources from the economy if you let it by itself, okay? So for that reason, for example, you need to have rules about what they can do and what they cannot do, and you need to have rules about how they allocate resources. That's the second approach. And this is a very common approach as well, especially among critical economists who are looking at the economy more critically. Now, there's a third approach that we can use, which is, as you'll see, you might actually see sort of like a combination of these two different approaches. Okay? Now, in this approach, what I call the Marxian approach, so people who identify themselves as Marxians, what happens is that finance has two roles in the economy. Okay? Just like the first approach. However, in the process, financial sector could create problems in the economy as well. They would help with accumulation, but undermine accumulation at the same time. They could help with certain problems, but create other problems. And we'll see how this plays in the US economy. In the US economy, we'll see how. And then there's a literature about that. We can talk about this as well. But problems, according to this approach, in the production side, in the real side of the economy, could lead to problems in the financial side. And the opposite could happen. There's that kind of sort of an approach here. So there are three different approaches. Am I going okay? Am I too fast?
¿Entienden?
Good.
¿Hay alguna duda?
Okay, perfect.
Perfecto.
Now, let's keep these in mind, these three different approaches. What we have, and some of you might actually be familiar with this. I saw that Dr. Levy works about financialization as well, so some of you might be already familiar with these approaches. Let me just, okay? Sorry. That's okay. Okay. So, when you look at the world economy, after about 1980, and more like after 1990s, you see a process where, at the general level, the size of the financial sector grows at a very fast pace. Okay? And at the same time, the significance of finance, financial markets, and financial institutions increase in the last 30 years. Okay? This process is what I call, and many others call, is the process of financialization. Financialization of the economy. Okay? Now, a couple of things happen in this process of financialization. What happens is, at sort of like at the firm level, the relationship between firms and financial markets in the US economy has changed. Okay? From 1950s till 1980s, the relationship between financial sector and the firms, non-financial firms, firms that do production, was like this. Financial markets would provide credit, okay, at low rates to the firms, and firms would use this in order to make investments, okay? And when the firms made profits, most of the time, they would use these profits in order to invest again, okay? So they kept making profits, investing it in their operations, and when they needed credit, they borrowed from the banks at more or less low interest rates, okay? And the banks, their main business was just to lend money and then wait until the money is paid back. You lend money and then you wait. In fact, banking was something boring. Yeah, you don't do anything, you just lend money and then you wait, they come back, they pay. Okay, what's that?
The 3-6-3 rule.
The 3-6-3 rule. The rule was this. So this is kind of a joke. But the banks would pay 3% interest. So if you put your money in the bank, you would receive 3%. Then they would lend this money at 6%. The difference would be their profits. It was more or less, constant. So 3-6-3 refers to borrow at 3%, lend at 6%, and go to play golf at 3 p.m. Because you don't have anything to do. You take money, you lend money, and you wait. In that sense, the finance was passive. They weren't doing a lot of things. They were just lending money. And the firms were using this money to make investments. Okay? Invest in production, invest in trade, invest in whatever. But increase the size of the production. They would make profits, keep those profits, and then invest those profits again. What happened, starting in 1970s and more in 1980s, was a change in the setup. What you have are two things. On the one side, the firms began making loans themselves. Firms that are not banks, non-financial firms, started investing in financial markets. They had a lot of profits, and they started using these profits not for investment, but for buying financial assets, making loans, and stuff like that. And on the other side, the relationship that I just described has changed. What happened was, now financial markets demanded more and more from these firms. Basically, what they demanded from the firms was a larger share of their profits. What they told the firms was, give us more of your profits, because if you don't, then we'll create problems. What kind of problems? One was what we called shareholders. Those who hold the shares of the firms demanded more money from the firms. And what happens in 1970s and 1980s is that the shareholders, those who own the firms, turned to be what we call institutional investors. Institutional investors are large financial firms, including pension funds, mutual funds, hedge funds, these large, very large financial institutions that oversee very large amounts of investment. So they started controlling the majority of the company shares, the firm shares. And they had one goal. Their goal was to make as much profit as possible. Okay? And how do you make as much profit as possible? If you're owning shares, you turn to the firms and you force the firms to give you more of their profits. And in order to do this, they did two things. First, they told the firms, the managers of the firms, that if you don't give us enough money, we will create trouble. We will create problems. We will sell your shares. We will sell all your shares. If you sell all the shares, the share price of a company goes down. Or we will take over the company and get rid of the management and bring in a new management that's going to distribute more profits to the financial firms. Okay? So this was one thing, to scare, so to speak, the managers of the firms. But they did a second thing as well. They also gave incentives to the managers to do this. they said what we have, for example, in the US is the managers of the firms receive part of their pay as stock options. Stock options are these. You, as a manager, you receive some stocks of the firm, okay? So you become a shareholder in the firm. And you can sell these stocks whenever you want, okay? So your aim as a manager is to sell these stocks at a high price. And how do you sell your stocks at a high price? You can do something to make sure that the share prices go up, okay? So the managers on the one side were forced, because otherwise you lose the company, and on the other side they were given incentives. Okay? So there's a stick and there's a carrot. So the stick is getting you to do this and the carrot is giving you the incentive to do this. Okay? And one way to do this, if you think about the stock market, one way to increase the stock prices is, well, there are two ways. One way is to pay higher dividends. If you pay higher dividends, the price of the stock will go up because it brings extra return. The second thing you can do is to go to the stock market and buy your own shares, your own stocks. Okay? If the firm buys its own stock, what happens is, think about it as a normal market, as any market, there's more demand for the stocks and less supply of it. That also increases the price of the stocks. Okay? So through these two ways, now you have a different relationship. Now the firms are giving more of their funds to the financial markets as dividends, as stock buybacks, and for a period as increased interest rates as well. Okay? So the firms are doing two things at the same time. This is a very fundamental change. This is a very significant and very fundamental change. Firms that are producing things began to give more of their profits to the financial markets, and at the same time, they themselves began investing in financial markets. Okay? So two things at the same time happening. And this is very important. This is a very important factor behind the crisis of the US economy, as we're going to see. Okay? So what happens in the US economy? I'm going to show you some numbers to prove that I'm not lying. This actually happened. It's not just a story. Now, look at this number, for example. This is a graph of the income of the financial sector as a percentage of the national income of the US. Okay? So most of these graphs, I don't know if you can read it, but most of these graphs start in 1950, 52, all the way to the 2010s. Okay? So what you see is, for a long time, the share of finance is more or less the same. It goes up and down a little bit, but more or less the same. This is sort of the period when finance was regulated. After 1980, so this is 1980, you see that this share begins increasing. In other words, more of the national income is now going to the financial sector. Okay? So here, for example, it's about between 12 and 14%. And when you reach here, it approaches to 20% of the national income. Okay? So that's a very significant increase that goes to finance.
What do you include in financial sector income? The profits of the banks?
The profits of banks and financial companies. The funds and other
So
types of...
not stock holder
No,
gains.
no, not the...
So this is...
Actual returns.
But it's nothing to do with what you said before.
I'm coming to that. Okay. This is about the first one. This is... Okay, it has something to do with it.
Let's see.
An increase in the size of finance. Okay? It's a general increase. So I'm coming to that. This shows the first thing. No, that's good. That's okay. This is the first thing. Let me show you something else. This is comparing the profits of non-financial firms and financial firms. Okay, so on the one side you have banks and other financial institutions. Their profits, that's on the top, and in the bottom you have the non-financial firms' profits, the firms that do production. So this is interesting. If you take the ratio, for a long time, the financial sectors, the financial corporations' profits are about 10 to 20% of the other firms' profits. After 1980s, this keeps increasing as well. It has its ups and downs, but at some point it reaches 75%, which shows you how finance became a lot more profitable than the other non-financial sector of the economy. Okay? So that's the second thing. The third thing is only the banks. Okay? If you look at the banks, this is sort of like the profits of the bank as a percentage of their total assets. So as a bank, you have all sorts of assets, and then you make profit out of this. Okay? What they did, this is the percentage for a long time in the regulated period. And then you have the 1980s, this sort of like goes down. The US has, the banking sector has a crisis in 1988. Okay, so, but after that, the profits of the banks keep increasing, and now they are settled sort of like at a much higher rate. So for example, here this is about 0.6, here it's about 1.2. It almost doubles. Okay? So the financial sector's profits increase, and among them, the commercial bank's profits increase really fast as well. Okay? And as a result, you also see more and more people initially working in the financial sector. So if you look at it, there's an increase. But that increase sort of stops in the early 1990s. Okay? And then there's sort of like a decline and a more or less a constant. So this shows you that finance grows, but it does not need a lot of employment. Initially, it increases employment in the financial sector, but after a point, you have, as a ratio of total employment, that remains pretty constant, starts going down. And you can imagine how this is happening. You can imagine how computerized all these transactions are and stuff. So that's an important thing in the sense that this is this growth of finance is not necessarily creating employment. It's not necessarily creating jobs, so to speak. Okay. However, even though the employment is not increasing after a point, the pay that the financial sector employees get keeps increasing. Okay? There's a slow trend here going up, but after a while, that sort of increase is really fast. This includes the compensation, the pay that people in the financial sector get. And this increase is mostly an increase that goes to the people that are occupying the top places in the financial sector, the managers of the financial corporations, the managers of banks, and so on and so forth. So there's a very sharp increase over there as well. Now, this is also something that shows what's going on in terms of the shares. This is the New York Stock Exchange, the daily volume. The daily volume means the number of times a share is bought and sold in one day. Okay? So if you look at it, this is 1960. The volume is very close to zero. Yes. Goes up, this is 1980. Still very close to zero. What does this mean? This means that those who bought shares were keeping them. Okay? You buy a company share, and then you keep them. Is you sit at home, and every time the company makes a profit, they'll send you a check. Okay? That's pretty much it. That was. However, after that, you see a huge increase in the trading of shares. Okay? Which tells you this time that those who buy the shares don't hold them. They keep trading them. So what they're doing is they don't really care about owning the firm. What they care about is the changes in the stock price. Okay? They're trying to make a profit. So imagine yourself holding a share. If you're holding a share, if you own the company, and if you're not selling it, then you're not really very much interested in what's going on, as long as you receive some dividend payments. But if you keep buying and selling it, okay, what you're after is the gain you're going to make out of this. Okay? Now this can become interesting for a firm, because the firm, for example, if people sell the firm's shares, if the firm's share price goes down, then someone else can buy the firm and change the management. But here, you know that no one is like taking over the firm. The management is, so to speak, safe. Here, the management is not safe anymore. All right? So that's true. This goes with that. This is the same stock exchange, New York Stock Exchange. This is the turnover rate. Turnover rate tells you, on average, how long a shareholder holds the share. Okay? How long do you hold the share of that company? Okay? Now, if it's about 20%, this is more or less 5 years. Long period, so you don't. But then it reaches to 100%. So on average, you hold the share for a year. There's a lot of trading going on. So if you put those two different data together, this tells you that there's a lot of trading going on, that there's a lot of uncertainty about who really owns the firm. Okay? The owners, in other words, are focused on the short term. If you own a firm here, that is, if you hold a stock for 5 years, what you care about is firm's investment and profits, because that's where you're going to receive. If you own the firm for a very short amount of time, what you care is the short-term profits of the firm. Okay? Here, you wait. But the firm can make an investment. An investment usually takes time. After a couple of years, you receive the profits and stuff. So you have patience here. Here, you don't have patience. Here, the financial market wants the returns as soon as possible. Because of that, this period is sometimes referred as the period of patient finance, and this period is impatient finance, that you want to get returns as quick as possible. Okay? Now keep that in mind. You want, the shareholders want to get returns as quick as possible. Now, I'll come back to this, but let me just show this first. This is for the firms now. That was the financial sector. This is the non-financial firms. As I said, one of the main aims of the non-financial firms in this era became to keep their stock prices high, to make sure that the stockholders are happy. In other words, to give more resources to the financial sector. One way of doing this is the dividend payments. So if you look at this, again, this is after 1987 or so. The non-financial firms give more and more dividends. Think about a firm. A firm makes an investment, produces things, sells things, makes a profit, and then keeps part of that profit for investment and gives the rest as dividends. Okay? Now they're holding less for investment and they're giving out more dividends to all sorts of shareholders. Okay? That's something going on. But this is not the only thing that they do. They also give money to the stock market by buying back their own shares. This shows you when the firms go to the stock market and buy back their own shares. Okay? Which means basically giving the money to the shareholders. So what you see is for a long time you don't have buybacks. On the contrary, you receive funds from the financial markets. After a point, this is 1980s again. After 1980s, there are very few years when the firms did not buy their stocks back. But most of the time, they kept buying back their own stocks. So in other words, when the firms had their profits, they started giving them out as dividends or by buying their own stock back. So the firms kept giving their money back to the financial markets. Okay? Now this becomes very important as well when you look at the investment behavior of these firms. But what they did basically is if you add interest, the dividend payments and stock buyback, that's a significant part of it. Now, at the same time, as I said, the firms began financializing themselves as well. By which I mean, instead of investing in production, they also started investing in financial sector. Okay? So the firms, the non-financial firms, began buying financial assets. Think about it like this. If you're a firm producing, let's say, cars, what you can do is you can buy parts of cars, you can build a plant, you can build a factory, you can enlarge your production capacity, or you can use your profits just to buy financial assets. Okay? If you do the first, you can make a profit, but it takes time. If you do the other one, you could actually make a profit much faster by buying and selling financial assets. So, if you compare them, this is the financial assets of these companies as a percentage of their total assets. What you see is they always had some financial assets, mostly trade credit, but after a while, it keeps increasing. Here, 50% of the firm's assets are financial assets, which means basically half of their assets are for production and the other half is financial assets. Is investing in financial markets, making loans, buying other types of financial assets, speculating in financial markets, so on and so forth. As a result, they make a significant amount of profits out of financial operations. So this only shows their dividends and interest income. Okay? And you see that there's a significant increase as well. It's not stable, it keeps going up and down because the financial profits are usually not stable. In one year they're higher, in the other year they're lower. But it keeps overall going up and it's very high. Okay? Now this is interesting. For example, if you look at the US companies one by one, okay, you see that almost all of the large companies earn a very large share of their income from financial operations. Okay? For example, you guys know General Motors. What do you think General Motors, the GM, does? What do they produce? They produce cars. You know, if you look at their books, you will see that the General Motors earned more than half of its profits, not from producing cars, but from lending money and from investing in financial assets. Now this is very interesting. Okay? The same thing for GE, the General Electric. What does GE produce? The GE produces, as the name says, electronic products. Okay? Same thing for them. If you look at their balance sheet, if you look at their income statement, you will see that half of their income comes from financial assets, financial investments. Okay? There are different reasons behind this. One important reason is that they also want to make quick profits. It's much easier and faster to make profits through this way. Okay? So, these are all to show that there are numbers that sort of like show us that the story I was telling is true. I'm not just making it up. So, now let's relate to this. Let me just go with this. As we've seen, if you divide these three different approaches that I talked about at the beginning, the first approach said the growth of finance is good. If you have more finance, you have better allocation of resources, you have less risk, you have all the good things that come with it. The other two theories said, the Keynesian one and the Marxian one, said that, well, not necessarily. The first one said, if you have a big finance, it could create problems. And the other one said, finance has what we can call a contradictory role in the economy. It helps the economy, but it also undermines the future of the economy in a sense. So there's a contradiction there. And we'll see that this contradictory role of finance is very much at play. It's kind of complicated, but very much at play in the US economy. After 1980s, finance was a very central factor in the US economy that, on the one side, created high rates of growth, contributed to the accumulation, but on the other side, prepared the conditions for the crisis. That's the contradiction I'm talking about. It helped the economy, but at the same time, it created the conditions, it prepared the crisis. How did finance do this? There are four main ways through which finance did this, or through which finance and the rest of the economy interacted. Okay? After 1980s, in the US economy, there were four main problems. The first one is what we can call sluggish aggregate demand growth, or in other words, slow growth of aggregate demand. Okay? The demand in the economy was not growing too fast. That's one problem, and we'll see why it was. The second problem, the profitability of the non-financial firms was low, and they had a significant amount of what we can call excess capacity. That was the second problem. The third problem was the US economy, since 1980s, periodically had speculative asset bubbles. In the 1980s, in the 1990s, and in the 2000s. In the 1980s, it was the land boom, in the real estate boom, mostly in the South. In the 1990s, it was the high-tech boom, the high-tech companies. And in the 2000s, it was again the real estate boom. And the fourth issue was what's called now the global imbalances, that is the large trade deficit of the US economy. Okay? Let's go one by one. The slow growth of aggregate demand. Why did aggregate demand in the US economy grow slowly? The main reason behind this was, in the US economy, the wages of the majority was not growing. The wages of the majority was either declining or stagnant, not growing though. And the reason behind this is, there are many reasons behind this, but in the 1980s, first, the power of the trade unions declined. Less and less people, less and less workers in the US were unionized. So they lost the power of collective bargaining. There was an increase in what we can call the reserve army of labor, or in unemployment. Okay? An increase in unemployment also means that the workers did not have power to increase their wages. Okay? And if you think about globalization added to this, the firms had the upper hand, the firms had the power. The firms would tell the workers, if you don't work at this wage, I will move my production to somewhere else where it's cheaper to produce. First, well, as you know, it was Mexico, so it was like going south of the border where it was cheaper. Then it was Asia, China, and all those places, especially China, where there's about 1 billion people that's ready to work at much lower prices. So that meant a decline in the wages in the US. Okay? Now you can add a lot of other things as changes in the labor market, regulations, a declining sort of help of the government to the workers, and so on and so forth. But the first two are the main items. So let me just show again that I'm not lying. This graph shows you two things. Okay? The blue line shows the productivity of the worker. You know what productivity of the worker is. Think about it as how much per hour you produce. Okay? And that has been going up. And the red line shows you how much you receive as a worker. In other words, this is what you produce, this is what you receive. Okay? This is what you produce in 1 hour, this is what you receive as hourly wage, for example. You see that the gap between those two has been widening. That's sort of like that shows you that what was going on in this case was the workers were producing more and more. Okay, their productivity was increasing, but in return they were getting less out of those productivity increases. For a long time, until sort of 1980s, these two lines move together. In other words, if you start producing more, you receive more. Okay? Which means that you can buy more, your demand goes up and stuff. But here, you produce more, you receive less, which means you can't buy, if you think in macro terms, you can't buy all you're producing. Very important, you'll see. Now, this one shows the real wages in the US on an hourly basis. So this is average hourly wages in fixed dollars, in real terms, okay, for the US, starting in 1964. You see that in the 1960s into 1970s, wages were going up. Then, for a long time, the real wages declined. This is mid-1990s, 95 or so. After 96, 97, there's an increase. But if you think about it, even at the end of 2000s, the wages were still below what they were in 1970s. In other words, an average worker in the US in 2000s earned less than he would have earned in 1970s. Okay? So productivity is going up, but your wage is not going up. There's this big gap that goes with the other figure. Okay? Now, why is this a problem? This is a problem because there is more production in the economy, but less demand for that production. Okay? There are all these goods that are being produced, but there isn't enough demand to buy these things. Your wages are going down. Now let's think about this. If your wages are going down in real terms, in other words, if you can buy less and less as a worker, as someone who works, what would you do? Many different things. The first thing you can do is you can work more, right? If your wage is going down, you can work longer hours. You can work 2 jobs, for example, to make up for the difference. That way you can. A lot of people in the US started doing that. They started working longer hours. The second thing you can do is think about the household. more people in the household can begin working. For example, if you have a high wage, only one person in the house can work. And that was the case in the 50s and 60s into 70s. But then if it's not enough, then the other person in the house needs to work as well. Okay? So you see, after 1980s in the US, more and more women began working. And then teenagers can also join the job market. You observe that. That's the second thing you can do. Just keep working more. But if your wage is declining, and at the same time, this is crucial, the workers in the US, the people in the US, were used to consume more and more. So you want to consume more, but your wage is not going up, so you work more, and what else can you do? Well, the answer is you can go and borrow money, because you want to consume. Your wage is not enough, you're working, it's not enough, so you can go and borrow. Okay? If you borrow money, then you can consume as much as you want to. So that's sort of the idea. Now let me show you something. This is the borrowing of people in the US, the household debt, as a percentage of the GDP. The GDP is the total production. This is total household borrowing in the economy. It increases in the 40s, 50s, and then it's kind of stable for a long time until 1980s. This is 1985 or so. After 1985, there is this increase. And then after 2000, a much faster increase. Okay? If you look at this, this is 100% of the GDP. Right before the crisis, this is the peak of borrowing. Right before the crisis, the total borrowing of the households was almost equal to the total GDP of the US economy. Okay. Now this is important because a significant increase in borrowing was one of the main reasons behind the crisis in the US economy. If you think about this, this has its own problems. On the one hand, what happens is the demand is low, but you can borrow and consume more. So finance helps the economy, helps the growth. Without borrowing, people would not be able to consume. But on the other hand, now finance was also contributing this problem because finance was demanding more and more profits from the firms, right? If the finance is demanding more profits from the firms, one of the things that the firms began doing was they started laying off workers, firing workers, okay, so that you have more, decreasing wages, moving production to other places, okay? So finance pressures the firms, the financial markets pressures the firms, they pay less to their workers, and now finance lends money to these workers so they can still consume. You see what I mean by contradiction? At the same time, finance was creating these conditions and helping them for a temporary period, but that was the case. Okay? The second thing, for the firms, what was going on was that if the demand grows slowly, okay, you have a problem to sell your products. That was one problem for them. At the same time, after 1980s, the US firms faced more and more competition from other firms in the world. Okay? When there's competition, you can't quite increase the prices. Okay? And when there's competition, in order to stay in business, you need to make investments. For example, think about GM or Ford, the companies that produce cars. They're competing with Toyota. Okay? Now what you need to do to compete with Toyota is you need to make more investments to produce better cars. Okay? But at the same time you need to be able to sell your cars. You see the problem here? You need to invest, you need to sell your cars, but there might not be enough demand for your cars. Okay? So what these companies began doing was they started lending money to their own consumers. They started, you want to buy a car from me? I will give you the money. And I'll lend you the money, and then you pay back to me. Okay? So that was set up. So this is good because I not only sell you the car, but I also make a profit by charging you an interest. Okay? So that's part of the financialization. So this is good. Finance was helping them. Because if it wasn't for the finance, these companies would have collapsed. So finance helped them both to sell their products and to make more profits. Okay? But at the same time, by helping them, finance made it worse. Because normally, if they weren't able to do this, some of these companies would have gone out of business. They would have gone bankrupt. And the others would have the market for themselves, so the others would be healthy. But now, what you have is all the firms are doing the same thing. And since they're competing with the other firms, they keep investing. And they have a capacity that's huge, but they can't use that capacity. So their profits keep going down. Okay, they can't make enough profits for this, and they do more finance. All right. For example, I don't remember the exact numbers, but for GM, when the crisis hit, they had an excess capacity where they could produce a couple million more cars if they could sell it, but they weren't able to sell it, so the factories were not functioning. Okay. So, for example, this shows you the profits of the financial, non-financial firms. The profitability goes down, and then the profitability kind of improves in the 1990s. Then you have a decline in 2000 because there's a crisis, and then increase again. This improvement in profitability is, as I said, partly due to financialization. Okay? Because they were making financial profits, they were able to sell their products through financial means. This is a contradiction as well. Finance helped these companies and undermine them at the same time. Okay? Let me talk a bit about the third one. The third one is what we call the speculative asset bubbles. The asset bubbles, you know what an asset bubble is. An asset bubble is when the price of an asset, say land, housing, or stocks, increases at a very rapid rate and reaches to unsustainable levels. Okay? Now, the asset bubbles created financial fragility, created problems for the economy, but they also helped the economy. They helped to financing consumption. Think about 2000s. The housing prices in the US have been going up really fast. Okay? If you own a house, which means if you own a house, your wealth was increasing. Okay? If your wealth is increasing, then you can go to the bank and borrow more. And if you can borrow more, then you can consume more. Okay? Because the bank is going to lend you and ask for a collateral. You'll say, okay, I have this house, it's worth this much. Then you can borrow money. Okay? So the asset bubbles help people to consume more, which means it helped firms because they could sell more. But there comes a point when the asset bubble comes to an end. At the end of 1980s, at the end of 1990s, and at the end of 2000s, you have 3 crises in the US economy when the asset bubbles end. The last one was the biggest one of them, but there were ones before that as well. Finally, all of this connects when you look at the trade deficit of the US economy. This blue line, which is, until 1980s, here around 0. So the US exports and imports were more or less equal to each other. But after a point, it starts going down. And especially after 1990s, the deficit grows. The US has a large trade deficit. when you have a trade deficit, that means that you have to have a surplus on the other side. Or in other words, if you're buying all these products from the rest of the world, you have to pay them. And you pay them in US dollars. Okay? Now what's going on here is mostly the US companies, instead of producing in the US, taking production to other places in the world. Producing that and then bringing it back to the US. Okay? Now, the only way you can have a trade deficit go on for a long time without a crisis is if you have some way to pay for it. And the US had some way to pay for it by using the US dollar. So if you look at the red line shows foreign owned assets in the US. In other words, red line shows how much the foreigners hold in terms of US dollars. Okay? Now, without this, the picture will not be complete, because at the same time, you're seeing four things happening. You have companies producing outside and bringing them inside the US to sell. Okay? And to be able to do this, you have less jobs in the US, lower wages, but you have to bring and sell these products. So finance helps it. People borrow and consume. But you need more finance for this. And that happens because foreigners are also investing in the US economy, in the US financial markets. Right? They hold US government bonds, they hold all sorts of other US financial assets. So the picture is completed if you add all these sides. You have the households, consumers, you have the firms, you have the bubbles, and then you have this trade aspect of the situation. All of these together show that in the 1990s and 2000s, finance both helped the economy and destroyed it at the same time. Okay? Without finance, without financialization, so to speak, without an increase in the size and operations of finance, you would not have this growth in the US. And you would not have the crisis either. You probably would have had the crisis earlier. So with the finance, you have this period of increase and then collapse going on. So to conclude, financial markets and institutions play what we can call a dual role or a contradictory role with respect to the rest of the economy, which meant that they helped temporarily solve some of the problems in the US economy, but while they were doing this, they created other problems in the economy. Okay? So that's sort of the general idea that I wanted to present to you here. I'll stop now, and if you have comments, questions, objections, whatever, we can talk about them.
¿Quieren parar un momentito? Porque creo que tomar agüita y volvemos a las preguntas, con todas las preguntas que tengan, ¿verdad? Thank you very much. Fue muy claro y muy actual qué pasa con la visión dominante. Y yo nada más añadiría un elemento que puede ser importante para la discusión. El mainstream, los dominantes bajo las versiones que quieran, incluida los nuevos keynesianos, que creo que aquí es lo que más se puso, garantiza que se generen ahorros, aunque bueno, los nuevos keynesianos hablan de algún nivel de desequilibrio, ¿ya? Pero en general se garantiza que haya suficiente ahorro, liquidez para generar un crecimiento económico, y desde esa perspectiva la política económica, particularmente la política fiscal, no es bien vista desde el mainstream, por todas las razones que se señalan de eficiencia y funcionalidad del sistema financiero. Creo que es lo único que añadiría a la parte de los mainstream. Cuando hablan de Keynes y los post-keynesianos, yo creo que ellos también hablan de la posibilidad de crisis, ¿ya? Dice, esto funciona así, que no es exactamente Keynes, pero diríamos que estaría en esta visión. Ellos hablan de auge, recesiones, y el mismo Keynes. Creo que si uno lo leo, no tanto en la teoría general, yo prefiero leer a veces a Keynes en el Tratado del Dinero, que me dice más, no le está hablando tanto de democracia. En este sentido, creo que también avanzan los post-keynesianos al identificar un problema de distribución del ingreso en el mercado de capital. Creo que los circuitistas lo hacen mucho más claro, como desde la perspectiva francesa, la perspectiva italiana, y creo que los caletianos hablan mucho más claro de la distribución de la ganancia y la pugna. Y creo que es una parte muy, muy importante para entender qué está pasando en el mercado de capital. En ese sentido, yo introduciría nada más el problema de incluso ver a la tasa de interés como una variable que afecta la distribución del ingreso. Yo no la vería más como una relación que afecta la inversión y el ingreso, sino vía distribución del ingreso, que es lo más interesante. La visión marxista faltaba, aquí nos decimos marxistas, tenemos 8 cursos que se estudia marxismo y a veces no tenemos claro la primera parte. Y creo que aquí nos dieron una refrescada de lo que es el marxismo, particularmente el capital financiero. Es cierto que Marx no lo trata a profundidad, pero no se le puede pedir que el señor viera a 300 años, bastaba que vieran los conflictos inherentes del capital. Y en ese sentido creo que sí está claro que el dinero es un signo de poder, es endógeno al sistema, el crecimiento económico no depende del ahorro. Y creo, aunque pareciera un poco una grosería hablar de la teoría de la explotación, en este mundo, pues no digo que en esta universidad, pero no, miran feo cuando uno habla de lucha de clases. Y creo que está fundamental esa esencia dentro de la crisis que hoy día tenemos. Y en ese sentido creo que el capítulo, especialmente en el tomo 3, Marx habla de las peleas dentro de las clases dominantes, entre los rentistas y entre los industriales. ¿Ya? Y cómo cuando el capital financiero domina el capital productivo, quien sale perdiendo son los trabajadores, ¿ya? Porque hay una extracción mucho mayor es mayor el excedente, la explotación de la mujer. Hay una parte que, bueno, no la toca Özgür, pero yo la veo y creo que él la ve también cuando mira desde las relaciones desde Turquía, yo las veo de México. La importancia de la internacionalización del capital y la globalización, la exacción de excedentes, sacar los excedentes de los países desarrollados desde los países en desarrollo hacia los países desarrollados. Creo que tenemos un personaje clave que lo menciona, que es Rosa Luxemburgo, ¿ya? Cuando habla que la realización de los países desarrollados se tiene que hacer en los países en desarrollo. Hoy día creo que esa tesis habría que refrescarla, porque tenemos un nuevo, no quiero sonar ideológica, pero sí tenemos un nuevo imperialismo, ¿ya? De que está movilizando excedentes de una manera muy peculiar, ¿ya? Y aunque tiene sus propias contradicciones, requiere de los países en desarrollo a través del famoso neomercantilismo, ¿ya? Para tener fuerza de trabajo barata, insumos baratos y crecer al menos más o tener mejor consumo que los países en desarrollo. Creo que estaríamos de acuerdo, pero no estuvo obvio en la plática. Yo lo introduzco porque creo que es una cosa que puede ser muy interesante. En este sentido creo que fue genial, me gustó mucho la presentación de qué hace de las cifras, ¿ya? Donde muestra punto por punto cómo bajan los salarios pero sube el financiamiento. Ahí está, creo que la contradicción básica. Y es Estados Unidos y no el capitalismo actual que puede hacer eso. En los demás países no hemos visto un crecimiento del financiamiento al consumo como se ve en Estados Unidos, ni siquiera en Europa, ¿ya? Ni siquiera en la Alemania. ¿Ya? Es en los países con mercados financieros anglosajón donde tienen tanto financiamiento al consumo. Entonces ahí habría que hacer otra revisión en qué pasa con el resto de los países, porque creo que ahí no es diferente, ahí un poco diferente, es lo único que en ese sentido. Es muy interesante lo que el profesor Özgür señala sobre las empresas no financieras. Hoy día son acreedoras y no piden prestado, ¿ya? Pero nuestras empresas, nuestras grandes multinacionales no funcionan así. Es decir, si nosotros hemos estudiado las empresas financieras, las grandes empresas no financieras mexicanas, y no son acreedoras, siguen siendo deudoras. Pero la exacción de ganancias viene a través de comprar la marca para vender. Es decir, aquí no hay innovación tecnológica, entonces en estas cadenas globales de producción ya simplemente se insertan. Y ahí me quería meter un poco en el problema del incremento del excedente, de la acumulación no ocupada. Es decir, lo que señalaste, y ahí me surgieron muchas dudas. Yo sé que el patrón de inversión cambió en el mundo. Primero tenemos un capitalismo que invierte menos, con una acumulación mucho menor, aunque gracias al financiamiento su rentabilidad no ha caído, porque ha caído la parte de la fuerza de trabajo. Pero no se da la inversión exactamente en Estados Unidos. En Estados Unidos ha bajado la tasa de inversión. Donde ha subido son en los países neomercantilistas. Alemania, China, India. A nosotros no nos toca, por la sencilla razón que somos unos exportadores muy sui generis. Nos volvimos exportadores, pero tenemos cuentas corrientes deficitarias. Y nos volvimos exportadores sobre base de mano de obra barata. Nosotros exportamos bienes con fuerza de trabajo barata. Es lo único que hemos podido hacer. No hemos podido pasar un nivel más allá. Entonces, en ese sentido, también conviene, bueno, ¿qué pasa en el mundo? Las transnacionales dominan, pero se comportan de distintas maneras en los países en desarrollo. Eso es una cosa que sería interesante ponerse a discutir. El problema de las burbujas financieras, que también se relaciona con la política monetaria, que esta parte no la trató acá, pero nos encontramos con burbujas financieras y con bajas tasas de interés, con políticas monetarias flexibles. Y aparece una dinámica muy peculiar, por decir lo menos, en términos que Estados Unidos pone tasas de interés muy baratas porque tiene burbujas financieras. Tomo prestado del sector bancario, compro títulos financieros, genero mayores burbujas financieras. Pero Estados Unidos es un país que le debe al resto del mundo, entonces con eso abarata su costo de financiamiento. Está genial, pero claro, eso propio Özgür dice claramente, es muy inestable. ¿Por qué es muy inestable? Porque depende que los títulos financieros sigan subiendo. No han seguido subiendo, ¿ya? No han encontrado, a diferencia de la burbuja financiera de los 80, de los 90, otro sector sobre el cual puedan generar innovaciones financieras. La innovación financiera no reaparece este nuevo sector, porque la vivienda parece que ya dio de sí en términos de la innovación financiera. Ahora, curioso, sigue funcionando este sistema. Es decir, lo más curioso, una de las peores crisis, la de 2008, y no ha pasado nada en la teoría económica, pero más preocupantemente la política económica. La política fiscal, nos volvemos keynesianos, llámenle como quiera, 3 meses, un año, para salir de la crisis, y después volvemos a esta forma de acumulación. Yo lo entendería por una mayor exacción del excedente de los países en desarrollo a los países desarrollados. Pero pueden decir que yo soy una terrorista, que estoy viendo que nada más le quitan a los pobres para darle a los ricos. Puede ser, pero no puedo entender cómo está funcionando este sistema si es que no tenemos un nuevo sector que se puedan generar innovaciones financieras. Creo que más o menos dije todo lo que quería decir, estoy segura que ustedes tienen cosas mucho más interesantes y nuevamente le doy las gracias a Özgür por la claridad con la que expuso este planteamiento. Actually, we have your book here. Abrimos la... Yo creo que... you want to answer or we gather a couple of questions?
I can get the questions.
Adelante, pregunten. Tranquilo, tenemos tiempo.
Dos cosas. Una, la presentación la vamos a tener.
They want the presentation. Sí. They usually ask it, so.
Es muy buena, es muy buena.
Gracias.
Un buen resumen.
Gracias.
La segunda es todos los casos generales que pusiste, que había platicado ya que estudio la industria automotriz, es mi tesis de doctorado, todos coinciden. Si agarramos General Motors, Volkswagen y Toyota, que son los que hago, exactamente. Crece la cuestión financiera, en el caso de General Motors que crecen los activos fijos, todo lo que pusiste, solo una gráfica que no sé si la entendí porque decía earnings, donde caen y después sube, pero no entendí que eran wages, que hablabas de salarios. ¿Son earnings o wages?
Wage earnings.
No,
Ingresos salariales.
La gráfica caía y en el 96 crecía, a ver si la tienes, y entendí que hablabas de wages, no de earnings.
No.
Esta, sí, a ver, son wages, no son salarios.
Son ingresos salariales. Es que no todos los ingresos salariales vienen de salarios. Puede haber una serie de...
No coincide, si son salarios, no coincide con la industria automotriz. Siguen cayendo los salarios. Sí. Desde el 91 siguen cayendo. En Estados Unidos.
La media. Sí, esa es la media.
Pero es Estados Unidos.
Estados Unidos también.
Fíjate, pero ¿por qué no agarramos 2 o 3 preguntas? Es decir, ok, esa. Podemos agarrar, chicos, por favor, aprovechen y pregunten. Bueno, una chica no está aquí.
Hay otro fenómeno que está ocurriendo en Estados Unidos, donde las grandes empresas se están manteniendo muy fuertes. No están ni invirtiendo en activos financieros ni invirtiendo en activos fijos en este momento. Y en México también se están dando, ¿no? La pregunta sería, ¿qué crees tú que está sucediendo?
Vamos a preguntar a los chicos, espérense un ratito, ¿sí? Se valen los estudiantes. A ver, ¿hay algo que tengan preguntas concretas? ¿O nos vamos a los de cabeza blanca? Estoy yo ahí con el problema que se
Bueno, considerando los diversos planteamientos teóricos, podemos entonces encontrar respuestas relativas entre cada uno de los planteamientos que se establecen. Pero la pregunta más bien sería como una cierta consideración, ¿qué se debería de tomar en política monetaria para poder resarcir, bueno, no sé qué tendencia ideológica o teórica manifieste, pero tiene la consideración que puso 3 planteamientos keynesianos, el mainstream y el marxismo, la política monetaria que se debería de tomar, qué condiciones debería tener o qué planteamientos deberían de instrumentarse para poder resarcir estos daños.
Carlos, y ya, y de ahí paramos para la segunda ronda.
Primero, well, first of all, let me congratulate you on your presentation, which was very clear. Okay. and you convinced me that it occurred, certain financialization of the economy. But I mean, let's go to the controversial point. We have two mechanisms which have occurred, main mechanisms during financialization. One, we put it very clearly, is based on the fact that the institutional relationship between managers, workers, and stockholders has changed. This has been very well put into broad model by Boyer first and then all the others afterwards. And they have their ideas done the banking industry in this model. There is another mechanism which you every now and then has been mentioning. It is related to the great growth of the banking industry, not only commercial bank, fire, insurance, all these things. This has changed quite a lot income distribution. And that has not occurred because the stocks, the price of the stock has gone up. It's occurred because they have been able to impose a change in financial regulation.
Exactly.
Now there are some other models which are not the Keynesian ones, which are the Sraffian ones, which put the stress on this other element of the change in distribution, change in the level of activity, and on the crisis, because the systemic risk has grown because of the change in financial regulation, which has allowed the banking system to grow at a tremendous rate. So this is, I think this must be very clearly distinguished, and then, but according to me, the second one is the more important, this banking crisis, not the first one.
You want to make it first?
Sure. I mean, with this one,
Yes, please.
this is basically average out, average, which means that a lot of other industries, like in a lot of other industries, wages were maybe going down. And I suppose, I'm not sure because you have to look at very detailed statistics, this increase here is mostly because of sort of like the division between high wage jobs and low wage jobs. Okay? There are certain jobs for which you see an increase, and there are other ones. And this changes after the crisis. After the crisis, the average starts going down again. I have some graphs of that as well. And that's mainly because of sort of the, what you can call bifurcation of the job market. There's sort of like two, so to speak, different sort of like bifurcation. And that's mainly that. And it's, as I said, it's average, so you'll see that. The second question about, if I understood correctly, the cash holdings of the firms. You see, I wish I had the other graphs as well. There's a very significant increase in that. Now, in this one, what you have, part of this too. Let me see. Part of this is very short-term assets that these firms are holding. But after 2008, there's a very interesting phenomenon. That is, you have a crisis, everything goes down, so the profits of the firms are increasing again. So you don't have much of a decline in the profits. And this, I suppose, is mostly due to the internationalization of production. Okay? But these firms have no use for this money, in the sense that the demand is low. You don't need to produce. They already have a very significant amount of excess capacity. Okay, so it's almost like the classic Keynesian liquidity trap. You just want to hold on to cash. And it's not only the firms, the banks in the US also have a lot of money as excess reserves. They're just holding on to money. one of the policies, main policy of the Federal Reserve after the crisis was to pump liquidity into the system, to give money to the banks with the idea that the banks would lend to consumers and firms, and this would help the US economy get out of the, that's quantitative easing 1, quantitative easing 2, and so on and so forth. What happened at the end is the firms, especially large firms, don't really need money. They have money, they're just not investing. And the banks are just holding on to money instead of lending it. And in my view, this is mainly because of those two things. You don't have growth in demand, you already have excess capacity, and the banks are better off by just holding their money at the Fed than lending and taking any risk in the absence of some fundamental change in the economy, which then sort of explains why you still have a very, very low rate of growth in the US economy. Since 2008, there's been talk of recovery. And the recovery now is kind of like go down. You're waiting for it, you're looking for every sign of it showing up, the employment numbers, this and that, but you don't see any change. For example, take the employment numbers. The unemployment rate in the US right after the crisis reached almost 10%. And then now it's kind of going down. But you know, the reason behind the decline in the unemployment rate is because people are starting to withdraw from the labor force. Okay? You know, unemployment is, you know, unemployed over labor force. If you're not in the labor force, if you're not looking for a job, if you're hopeless, then you're not going to be in the numbers. So even there, you know, you see some signs of recovery, but that's not real because there is no improvement in the unemployment. If you add them back, the unemployment is still very high. Okay, so when you put those three things together, then you know you can see that the firm. There's one thing that's not clear in terms of the cash holdings of the firms. We don't really know where they are holding their cash. It's possible that part of this is the foreign earnings of the US corporations that they don't want to bring back because of tax considerations, so they're just holding the money.
But it happens the same here.
It happens
In
Mexico también?
Yes, see. Yeah, it's amazing the amount of liquidity that the firms have.
Which shows that it's not an issue of liquidity, because that's what the Fed is trying to do, give more liquidity, but that's not an issue of liquidity. With the third question, help me here, the question is basically about the role of monetary policy. Is that?
Lo que preguntaba es sobre el papel de la política monetaria, ¿verdad?
Sí.
Okay. Independientemente de la visión teórica.
Bueno, o sea, digamos, habían planteado tres escuelas de pensamiento, pero digamos, es muy diferente lo que vemos teóricamente a lo que podemos llegar a aplicar. Ahí hay un universo de posibilidades en lo que se dice y lo que se hace.
Okay.
Digamos, en ese sentido, obviamente, bueno, creemos, a mi parecer, podemos regular, pero no sé. Pues,
sí. Ok. Voy a hablar en inglés. In terms of policy, monetary policy and general sort of like economic policy, in fact, if you take them one by one, you take the mainstream theory, the policy suggestion would be to do nothing. Okay? Basically, in fact, this is not a joke. In the US, economists, Chicago school economists, actually had a campaign advocating, after the crisis, that the government does not bail out anybody. Because according to the mainstream theory, in fact, you should let them fail so that you get rid of those who made wrong investments. Okay? So don't bail GM. Because the government, for example, helped GM, the US government helped GM. So they would say, don't. You don't care about the couple million workers that would go unemployed and blah blah. It's like, it's their problem. But in general, if they're not inefficient, if they're not profitable, they should just go bankrupt. So it's sort of like hardcore mainstream, so to speak. Okay? And then you have the central, the more sort of like Fed type, monetary policy type mainstream. And according to them, the main problem is that there was a disruption in finance, and if you fix finance, everything is going to be growing again. And that's the Fed's policy, that's the monetary policy. Let's just make sure that the banks have enough cash. Let's make sure that their capital ratios are okay, all right? Their balance sheets are strong. And then they will start lending, and all the problems. So according to that view, we don't have all the other problems I was talking about. The demand problem, the excess capacity problem, the asset bubble problem. In fact, they don't talk about this openly, but my argument is that they want another bubble. For all the reasons that, because the bubble contributes to the growth. And it sort of pushes everything to the future. Okay? But that's not happening. I mean, quite so. Because of various reasons. You have a stock market sort of growing up as well. But a lot of money that the Fed is putting in the market is flowing into developing countries. Okay? So you can borrow at almost 0% there and land at 10% somewhere else. So you're seeing a lot of bubbles, and that's actually what I'm going to talk about tomorrow. You're seeing a lot of bubbles in a lot of other parts of the world. So the policy is not. Now come back to the Keynesian position. What would you argue? Okay, regulation is the general policy, of course, right? You have to make sure. But right now, so I think one of the fundamental arguments of Keynes was that at times of crisis, monetary policy will not be sufficient. You have to have fiscal policy. You have to have the government spend large amounts to pull the economy up. This is sort of the basic argument. But on top of that, you can also add, there are various sort of like variations, so to speak, of the Keynesian approach as well. For example, you can do this by allocating credit to different sectors that need it. You can do this by allocating credit to infrastructure, allocating credit to what now is sort of called green energy and stuff like that. There are all these kind of arguments. And in terms of policy suggestion of the Marxian approach, it's kind of interesting that in Marxian approach as well, crises are solved, according to the Marxian approach, by the bankruptcy of a lot of firms. What happens is, if the companies go bankrupt, okay, two things happen. On the one side, you have unprofitable ones go out of business. Those who remain increase their profits because they capture markets. And unemployment goes up, which, not this graph, the previous graph, which decreases wages further. Okay? Which gives the firms more profits too. So it's similar to, in fact, the mainstream sort of thinking in that sense. Okay? But in terms of policy, the main argument would be basically, no matter what you do, this system will produce different types of crises. Okay? So you could regulate finance, then you have a different type of crisis. like in the 1970s. You don't regulate finance, you have a different type of crisis. Okay? You let finance grow, it helps accumulation. But you don't let finance, then it might actually not help. So what you need is not a policy suggestion, but sort of like the conclusion is that you have to think about reorganizing the economy. Okay? You have to think about reorganizing the economy. And then you can take this conclusion to anywhere you want. You could think about central planning, you could think about market socialism, you could think about self-managed firms, you could think about cooperatives. There are many people that extend this to different directions. So you have different sort of quote-unquote policy conclusions of that approach as well. So that would be sort of like, you're right, at the end it's better to sort of bring them back to the picture and talk about what they would say in this situation. But the last question. I'm aware of those arguments as well, and they are very important. In fact, that's not something I've had here, but I had it in one of my papers. The change in distribution itself is also part of this process, or it should be seen as part of this process, in the two senses. First, the change in income distribution and increasing inequality is one of the mechanisms behind this in two ways. On the one side, people at the bottom consume less, or their wages are less and whatever, so their demand is less. They need to borrow more. So that's the side that we talked a little bit about. But on the other side, you have this group who has increased their wealth, and what they want is ways of using their wealth. So they demand more complicated financial investment assets. They demand different types of financial assets. They chase higher. So they actually are effectively, if you look at the financial innovations, part of the financial innovations are made to cater to these people, right? So from both ends, actually, inequality is making financialization, driving financialization process. So that's one. But at the same time, financialization itself is creating more inequality, right? So all these processes we're talking about, for example, the pressure of the financial markets on the firms in terms of how they allocate their resources is one way of contributing to this inequality. So the way I think, I guess, is that it's difficult to say which one precedes the other one, but they keep feeding into each other. Financialization creates more inequality contributes to financialization. And at the end, you have this sort of like very complicated relationship, so to speak, that I'm trying to untangle here. I don't know if that sort of answers the question.
¿Habría alguna otra pregunta? Sí.
Menciona a Suisi la parte de la explicación. La teoría, el libro de teoría del desarrollo capitalista, Paul Suisi y Paul Baran plantean la teoría del excedente, un poco en la lógica de la doctora Noemi Levy. Entonces, esta teoría del excedente, hoy como en el neoliberalismo, no sé, Suisi, ¿cómo la ve? Porque este excedente generaba pues el desarrollo de la industria automotriz, el desarrollo de todos los hidrocarburos, de la guerra armamentista, la guerra espacial, y todo este excedente se canalizaba a hacer crecer el capitalismo mundial, ¿no? Pero ya ante la visión esta que planteas de las gráficas, en donde crece la productividad y los salarios caen, y hay un diferencial muy grande entre salarios y productividad. Entonces estás planteando que la crisis se mantiene básicamente a través de los bajos salarios, y hay un excedente, una plusvalía. Entonces, ¿cómo lo ves, Suisi? No sé, esa es mi pregunta específica. Me gustó mucho tu exposición, quisiera hablar más inglés para entenderte mejor, pero me parece muy brillante y te felicito.
Bueno, continuando con la parte de Suisi, esto no es más bien los últimos desarrollos en la economía capitalista americana de lo que él tenía como la madurez de las economías capitalistas, en las donde se tiende al estancamiento, y la financialización es el resultado de cómo salir de ese estancamiento por un lado. Y otro, ahora esto inaugura las crisis que, según Richard Q., refiriéndose a Japón, son las crisis de hojas de balance, donde ya no se tiene exactamente esa trampa de liquidez, porque si, en realidad lo que está pasando es que la demanda no va a reaccionar por el exceso de deuda que hay en los hogares. Entonces ellos pueden ver gran liquidez en los bancos, dinero en exceso, pero no lo van a pedir porque están en un proceso de desapalancamiento. Y otra, las bajas tasas de interés de Japón al final terminaron provocando la crisis asiática cuando ellos incrementaron sus tasas de interés. Esto de que tanto es un peligro, por ejemplo, para el resto del mundo, que Estados Unidos mantenga esta política de alta liquidez.
Una más.
Puedes tener toda la tiempo.
I mean, Marxian approach. We have huge amount of diversification. I think you also recognize that there are other parts which we did not mention. Very standards of Marxian. So you get all sorts of, I would say, the different positions there. It's not just, I mean, what do you consider the characterizing feature of the Marxian approach? The labor theory of value or historical materialism? If you take the first, then you have a very narrow group of people that have a lot of problems in dealing with finance, because the center of the contradiction is the firm, the productive firm, and not the circulation. If you take an historical materialism, which Marx had, mainly in the volume 3 of Capital, then you have much more interesting developments, finance, and you can also add social democracy as a way out of this crisis.
Quería saber, bueno, dado que mencionan que la financialización es un proceso más obvio en Estados Unidos, entonces quiere decir que tú crees que el fenómeno está ocurriendo en otros países como México o solamente en ciertas economías.
Okay. I think I can sort of combine those three questions in a way. I did not talk about the causes of financialization. And there are a couple of different approaches in terms of the Sweezy approach or monopoly capital approach, like a couple of other approaches, sees the main problem of the growth of monopoly capital and financialization as a solution to those problems. Okay, that's one approach. And this is, you can sort of like contrast this with post-Keynesian approach. In post-Keynesian approach, the growth of financialization is creating problems in the real economy. But here, the problem in the real economy is creating financialization. Depending on which type of Marxist you choose, of course, you will get a different approach to the issue. One thing, in my opinion, that we need to be able to do is, no matter which approach you're talking about, is to see that these relationships are not one-way streets. That is, you don't have, in my opinion, you don't have things happening in the real sector first and then causing other stuff in the financial sector. They're happening, that's sort of like my ideas here are, they're happening in a very complex and contradictory process, okay? And what's going on in that sense is, yes, financialization can be explained in different ways, but you have to see it's not as just beginning because of problems in the real sector. What you see, in fact, even the timing, the main problems, Sweezy and others, for example, Aigi talks about it, he has some sort of a Marxian approach as well, Giovanni Aigi. You see problems of the non-financial firms in the 1970s. In 1970s, there's a very sharp decline in the profitability. You have the stagflation in the US. But financialization, all these numbers, when you look at them, they start sort of like in mid-1980s. So it's not like an immediate response, okay, we have a crisis here, so let's go and financialize. But there are a bunch of policies. You have, as a result to crisis, you have, as a solution to crisis, you have policies of deregulation, you have policies of letting the banks grow and do whatever they want. You have the globalization of production at the same time. Globalization of production means you need globalization of finance, because mainly, and I talk about this in my book, the American firms who were going all over the world needed the banks doing the same thing. Okay? So it's not, I don't think that you can put the real and financial as separate sort of entities. They're very much connected to each other. Especially when you look at what the non-financial firms are doing. They are, right now, they're no different than financial firms. They earn a good chunk of their profits from financial operations. And in that sense, you know, I think, and my approach is to sort of like try to take a more nuanced and more sort of contradictory approach, in the sense that trying to see these two effects happening at the same time. It's difficult to untangle them. It's difficult to say this one actually precedes the other one, in my opinion. Okay. And in terms of the different sort of like solutions of Marxian approaches, of course, I mean, when you look at the mainstream approach, it's much more institutionalized. It's much more clear to see that what they would say. You could say even the same thing for Keynesian approach. There's more sort of institutionalized versions of Keynes. The Marxian approach is all over the place in that sense. You have different people sort of like developing different theories. But you're right. If you go back to Marx himself and Volume 3 especially, then you will see that you have a lot of material there to develop some sort of a theory of what is going on. In fact, from there you can jump to Hilferding, the finance capital. And Hilferding's approach was very interesting too. Hilferding studies the growth of finance capital and finds that 5 or 6 banks are basically controlling everything, right? And his conclusion was that all we need to do is take over these 5 banks, and then we will control the whole economy. Because basically, when you're talking about planning, that's those 5 banks were doing some sort of planning. So if you control them, you can do your own planning. So that would go over there. Your second question about how the U.S. low interest rates cause problems in the rest of the world. I could talk about it, but if you're going to be here tomorrow, that's sort of like what I'm going to talk about tomorrow. So we can discuss that here. And your question, the last question about financialization in the rest of the world. In fact, Dr. Levy would be in a better position to answer it for Mexico. She has a lot of work about this. I don't know the Mexican case in that sense, so, but you see that similar things happen in some countries, some developing countries, But it's not exactly the same thing. It's not exactly the same thing. Because you have a different structure. For example, financialization in the US means that these companies, on the one hand, the one side of it, make financial profits there, but allocate production to other parts of the world. Which means financialization in the US could mean some firms in other parts of the world begin investing and producing for this parent company. But also, these companies control a lot of different enterprises around the world. And you can see similar things in those enterprises, in that sense. I don't know how much, for example, the Mexican companies are financialized in that sense, but, you know, but you should read her latest book.
Bueno, un par de anuncios. El profesor nos ha mandado una literatura para la gente que esté interesada, está colgada en la página de posgrado, la pueden bajar tranquilamente. Y sí, me alegaron que no avisamos que se están vendiendo libros allá afuera, entonces si a alguien le interesa. Y, sí, y los esperamos mañana a la misma hora, esperando que sea igual de entretenido. Muchas gracias.